I think my speech spans noon, so good morning and afternoon to you all. It's a great pleasure for me to be in Dublin today. It's my hometown, although it's not the part of my hometown. I'm a North Sider, but I can still survive here. Good. No, first, it's a great privilege to have the opportunity to address this very important conference, so I'd like to thank the Central Bank for giving me that opportunity. As the very interesting title of the conference suggests, financial policymakers are currently required to navigate through a highly uncertain political and economic environment. And in less than 4 years, we've experienced a global pandemic, the invasion of Ukraine, and most recently, the very troubling events in the Middle East. And taken together, these developments have triggered profound geopolitical changes across the world with inevitable consequences for international economic and financial relations. And in such circumstances, issues of economic security have inevitably come to the fore. For the EU, economic security will depend on its ability to become more resilient to risks from economic linkages that, let's face it, in past decades were viewed as unambiguously beneficial. But I want to be clear, this does not mean that we should be building a fortress Europe. We should not abandon the openness of the EU economy or seek to decouple from global markets. The emphasis must be on de-risking, not on decoupling. But if we are to de-risk, we will need to improve the international competitiveness of the EU economy across a wide range of fields. And I believe that the financial sector will have a crucial role to play in that regard. Indeed, at least for me, it's difficult to imagine how the EU economy can be internationally competitive without adequate, and therefore hence improved, financing opportunities. And that brings me rather neatly to the EU financial services agenda. We're now approaching the end of this EU legislative cycle, and in the area of financial services, the Commission has delivered a very wide range of legislative proposals which are either already adopted or are currently under negotiation by the Council and the European Parliament. Now, it's not possible for me to cover more than 35 legislative initiatives in my remarks today, unless I'm to get you past midnight as well. But instead, I will focus on a limited number of initiatives in 3 key policy areas, which I hope will be of relevance to the theme of this conference. The 3 areas are sustainable finance, the investment fund sector, and retail investment in capital markets, which will no doubt be discussed a bit more, I think, in the panel that will immediately follow my remarks. So I'll start with sustainable finance. Addressing climate change, I think, is one of the great generational challenges we face, and it will require very heavy investment. The EU will need to invest about 600 billion euros more each year between 2021 and 2030 than it did between 2011 and 2020. And that's to decarbonize its economy and achieve its environmental objectives. The vast bulk of this financing must come from private sources. And to channel these private funding flows, the EU has developed a sustainable finance framework. The Sustainable Finance Framework is not rocket science, let me assure you. It's essentially about market organization. It comprises 3 elements: a taxonomy or a classification system to help investors identify what are sustainable activities, a comprehensive disclosure regime for corporates and financial firms to demonstrate the extent to which their activities are sustainable, and thirdly, a toolbox, labels, benchmarks, ratings, etc. All of these to allow investors to navigate the market more easily. While this framework is not yet complete, much of it is already in place. And today I'd like to draw your attention to a number of specific elements of the framework. On the prudential side, the Commission has proposed rules for ESG risk management and climate risk stress testing in its banking and insurance packages back in 2021. We have also mandated the European supervisory authorities, in close cooperation with the European Central Bank and the European Systemic Risk Board, to test the resilience of the financial sector during the transition towards the Commission's 2030 climate targets, and technical work is now underway on this. So this we are doing on the prudential side. On the conduct side, we are working to address potential misuse of the framework. We have again asked the European supervisory authorities for input here, and on the basis of their findings, the Commission will consider steps to ensure sufficient supervision and enforcement to address so-called greenwashing and ensure consistent outcomes for European consumers and investors. On disclosures and transparency, the relevant regimes for corporates and financial firms are now substantially in place with the Corporate Sustainable Reporting Directive, CSRD, and the Sustainable Finance Disclosure Regulation, SFDR. I should apologise in advance for the many acronyms that the European Commission produces. There are more to come, believe me. Now, as part of our assessment of the SFDR, we recently launched an in-depth consultation exercise. We want to know how the SFDR is working on the ground and if it is fit for purpose. Indeed, for the remainder of this Commission, the focus will be on consolidating the sustainable finance framework we have in place and taking on board stakeholder feedback on implementation challenges. We want to look at ways to improve the usability of the rulebook and minimise burdens, mostly via non-legislative tools. This will be like guidance to markets, frequently asked questions, as well as the consultation on the SFDR that I just mentioned. The Platform on Sustainable Finance, which we in the Commission set up, this is an independent group of experts. They will help here. And the platform will focus on further development of the taxonomy. This work will be supported by the recently launched stakeholder request mechanism. This stakeholder request mechanism is an online tool which allows stakeholders to submit suggestions on new activities that could be added to the EU taxonomy and/or changes to existing activities under the taxonomy. It will also examine the monitoring of capital flows to help us understand the progress that is being made on the ground. So as I've said, much of the sustainable finance framework is in place or in the process of being put in place. The challenge now, a bit in the line of the title of the conference, is to ensure that the framework is delivering the desired outcomes in channeling private financial flows to sustainable investments. Turning now to the investment fund sector, well, let me say that a competitive and resilient EU asset management sector is a prerequisite for delivering a robust EU capital market, ensuring financial stability, and delivering that economic security that I mentioned earlier on. So we need clear rules to make sure that the EU asset management sector is resilient in any economic situation. The Commission is well aware of and supports the increased regulatory focus on non-bank financial intermediaries. At the same time, the rules should not straitjacket the sector. They should allow our investment fund industry to be internationally competitive and to serve the interests of their customers. So let me briefly explain how the EU asset management framework is being adopted to reflect this balanced approach. Under this Commission's mandate, there has been targeted reviews of the AFMD and the UCITS directive. In particular, a number of microprudential tools relating to liquidity management have been included, reflecting work at the international level. We are somewhat ahead of other jurisdictions here, but the challenge now will be to ensure that these tools can also be activated at the macroprudential level. And indeed, we've seen a good example of such a macroprudential approach here in Ireland quite recently. Money market funds. Well, money market funds are an important part of the EU fund industry and, of course, are particularly important for Ireland. These funds have been in the spotlight since the market turbulence of 2020, March 2020. That collective experience, I think, taught us that it is important to make sure that they are regulated in a manner that makes them sufficiently resilient to liquidity shocks. On the other hand, we must recognise the important role played by these funds, including low volatility funds, as risk and treasury management tools for both the real economy and the financial sector. I believe that our recently adopted report back in July of this year on the functioning of the money market funds regulation strikes a good balance here. It recognises the economic role of MMFs, but certainly does not preclude a potential further strengthening of the rulebook for the funds. The report highlights that the money market fund regulation has enhanced financial stability overall. However, it also identifies vulnerabilities in the market for money market funds and areas which would merit further assessment, such as those linked to the functioning of the underlying short-term funding markets. The Commission has not proposed a revision of the legislation in this mandate, but we will continue to monitor the sector and related vulnerabilities to identify where there is need for regulatory action in the future. We also note the regulatory developments in the United States and in the United Kingdom, where regulators are moving to increase liquidity buffers for money market funds. In this context, it's worth noting that money market funds domiciled in the EU voluntarily hold more liquid assets than their regulatory limits and generally exhibit sound liquidity management profiles. They're closely supervised, subject to frequent stress tests and stringent liquidity risk management requirements that enable asset managers to increase their holdings of liquid assets when needed. Nevertheless, we might need to consider revising regulatory limits or other changes to the MMF regulation in the future, considering the specifics of the sector and relevant market and regulatory developments. Finally, under the funds heading, we see also important opportunities to boost the competitiveness of the EU investment fund sector, notably with the imminent start of the upgraded LTIF regime. This is positive news for the EU economy and for the development of the EU capital market. With their longer-term focus, LTIFs are an ideal vehicle to support much-needed investments in real assets like green energy, social and transport infrastructure, and listed and unlisted companies. But here I want to emphasize that the protection of retail investors is and always has been a priority. To that end, the co-legislators weigh the risks and have already put in place extensive investor protection safeguards such as suitability assessments, depository requirements, and extensive disclosures. So again, here, the challenge must be to ensure that the investment fund sector can deliver the desired outcome in terms of economic growth, while also ensuring that the sector is sufficiently resilient both to idiosyncratic and system-wide shocks. Let me finish my remarks with the Commission's retail investment strategy. I think increasing retail investor participation is crucial for the success of the Capital Markets Union. As is well known, EU households hold only 30% of their savings in capital market instruments and the remaining 70% in bank deposits. The opposite is true in the United States. Retail investor participation in capital markets can only be durably increased if those investors feel that they are fairly treated and sufficiently empowered within a strong regulatory framework. In considering the appropriateness of the relevant regulatory frameworks, the Commission identified fundamental issues which we believe should be addressed to boost participation on a durable basis. For example, levels of financial literacy across the EU are low, reflected in relatively limited confidence in capital markets among retail investors. Investment advice for retail investors is predominantly inducement-based, implying an inherent conflict of interest for the investment advisor. Meanwhile, the extent of the information asymmetry between a retail investor and his or her investment advisor suggests that the standard approach to managing such conflicts of interest, transparency and disclosure, may not be adequate in this instance. And finally, survey evidence confirms that retail investors tend to be sold products that are relatively complex, relatively expensive, and yielding relatively low net returns. So the Commission's proposal for a retail investment strategy attempts to address these issues of concern in several ways: by promoting greater financial literacy, which is now moving up the political agenda in many member states; modernizing disclosure for investment advisors by improving the focus on essential information and via digitalization; tightening the rules of marketing practices, including so-called finfluencers, I simply can't say that word, maybe they don't exist, to reduce the risk that retail investors are misled in their investment choices; improving the quality of investment advice by introducing a best interest tests instead of the existing quality enhancement and no detriment tests in the Market in Financial Instruments Directive and the Insurance Distribution Directive. We want to ensure clear disclosure of inducements that are being received by the investment advisors, and we propose to introduce a value for money approach to ensure that costs do not erode returns to the retail investor. This approach will include the establishment of pricing benchmarks. But I want to be clear, these benchmarks are meant as comparison tools to facilitate transparency. They are not meant as implicit price regulation. And finally, by introducing a so-called partial inducement ban, precluding the receipt of inducements on products where there is no investment advice at all. Now, I know that many of these proposals have proven controversial in the financial industry. To be honest, such controversy was to be expected, given how the financial industry has organized itself to provide investment advice. But we believe that retail investors cannot and should not be encouraged into capital markets to meet our CMU objectives unless we are satisfied that the outcomes for those investors are adequate. So, these were the 3 points I wanted to cover. So I will conclude by again noting that we are approaching the end of the current EU legislative cycle. Much has been achieved in this cycle, but inevitably thoughts are now turning to the next cycle. That's how it works in the Commission. I cannot prejudice the decisions of the next Commission, but clearly the focus will remain on financial stability, competitiveness, sustainability, digitalization, and making financial services work for citizens. But equally clearly, the macro-financial situation is in flux, and this high level of uncertainty must be taken fully into account in our thinking for the future. And all of that makes this conference very timely and very useful. Thank you for your attention, and I wish you all a very good rest of conference. Thank you.